Yo, hello, mic testing. It's working. In days 105. After studying this unit, you will be able to list out the objective and scope of the standard, define the terms non current asset, disposable group, cash generating unit, and discontinued operations. Examine the criteria for classifying non current assets or disposable group classified as held for sale. Disclose non-current assets or disposal group classified as held for sale. Present and disclose discontinued operations as per the standard. Elaborate significant differences between 105 and 24. So, let's go to the objective. Non-current assets held for sale are presented separately from other assets in the balance sheet as their classification will change and the value will be principally recovered through sale transaction rather than through continuous use in operations of the entity. This standard specifies the accounting for assets held for sale. Results of discontinuing operations should be separately presented in the statement of profit and loss as it affects the ability of the entity to generate future cash flows. This standard specifies the presentation and disclosure of discontinued operations. The disclosure information provided in the standard enhances the ability of users of financial statement to make projections of an entity's cash flows, earnings generating capacity, and financial position by segregating information about held for sale assets and discontinued operations from the information about continuing operations. Hence, two core objectives of the standard are as follows: accounting for non current assets held for sale or disposal groups, or and discontinued operations. So, accounting for non-current assets held for sale or disposal groups, we the measurement is done at the lower of carrying amount and fair value less cost to sell. So between between carrying amount and fair value less cost to sell, whatever is the lower, measurement is done at that. Cessation of depreciation on such assets and presented separately in balance sheet. In case of discontinued operations, results of discontinued operations to be presented separately in the statement of profit and loss, and there is a uh, separate disclosure to be given. Scope of the standard. The classification and presentation requirements of this Ind AS apply to all recognized non-current assets and to all disposal groups of an entity. The measurement requirements of this Ind AS also apply to all recognized non-current assets and to all disposal groups of an entity, except few exceptions mentioned below. Assets classified as non-current in accordance with Ind AS 1, presentation of financial statements shall not be reclassified as current assets until they meet the criteria to be classified as held for sale in accordance with this Ind AS. The classification, presentation, and measurement requirements in this Ind AS applicable to non-current asset or disposal group that is classified as held for sale apply also to a non-current asset or disposal group that is classified as held for distribution to owners acting in their capacity as owners. Scoped out non-current assets, the measurement provisions of this IND-AS do not apply to the following assets which are covered by the IND-AS listed either as individual assets or as part of a disposal group. So, measurement provisions of IND-AS 105 do not apply to deferred tax assets, IND-AS 12, income taxes, assets arising from employee benefits, IND-AS 19, employee benefits, financial assets within the scope of Ind AS 109 are talked about over there. Non-current assets which are measured at fair value less cost to sell in accordance with Ind AS 41, and group of contracts Ind AS 117 and insurance contracts. So this Ind AS 105 does not apply to all of these. Disposal groups may include both scoped in and scoped out non-current assets. If a disposal group includes any scoped in non-current assets, the measurements the measurement requirements of this index apply to the group as a whole, so that the group is measured at the lower of its carrying amount and fair value less cost to sell. The disclosure requirements of this index for non-current assets held for sale and discontinued operations remove the need to provide disclosures in accordance with other standards, unless that standard has specific disclosure requirements. For non-current assets or disposal groups classified held for sale or discontinued operations, or for measurement of assets or liabilities within a disposal group that are not within the measurement scope of Index 105. However, this does not remove the need to provide additional disclosures to comply with Index. Relevant definitions: cash generating unit is the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets or group of assets. Component of an entity comprises operations and cash flows that can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. Costs to distribute are the incremental costs directly attributable to the distribution, excluding finance cost and income tax expense. Costs to sell are the incremental costs directly attributable to the disposal of an asset or disposal group, excluding finance costs and income tax expense. Current asset: an entity classifies an asset as current when it expects to realize the assets or intends to sell or consume it in its normal operating cycle. It holds the asset primarily for the purpose of trading. It expects to realize the asset within 12 months after the reporting period. The asset is cash or cash equivalent as defined under Ind AS 7, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. A discontinued operation is a component of an entity that either has been disposed of or is classified as held for sale and represents a major line of business or geographical area of operations, or is a part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations, or is a subsidiary acquired exclusively with a view to resale. Disposal group is a group of assets to be disposed of by sale or otherwise together as a group in a single transaction, and liabilities directly associated with those assets that will be transferred in the transaction. A disposal group may be a group of cash generating units, a single cash generating unit, or part of a cash generating unit. The group includes goodwill acquired in business combination if the group is a cash generating unit to which goodwill has been allocated in accordance with Ind AS 36 impairment of asset, or if it is an operation within such a cash generating unit. Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Firm purchase commitment is an agreement with an unrelated party binding on both parties and usually legally enforceable that specifies all significant terms, including the price and timing of the transactions, and includes a disincentive for non performance that is sufficiently large to make performance highly probable. Highly probable, significantly more likely than probable. Non-current assets are assets that do not meet the definition of current assets. The recoverable amount is the higher of an asset's fair value less cost of disposal and its value in use. Value in use is the present value of estimated future cash flows expected to arise from the continuing use of an asset and from its disposal at the end of its useful life. Classification of non-current assets or disposal groups: as held for sale, as held for distribution to owners. An entity is required to classify a non-current asset or disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. Asset must be available for immediate sale in its present condition, and sale must be highly probable. Are the two key requirements to classify a non-current asset as held for sale. It may be noted that if an asset is being sold individually, Ind AS 105 applies only if it is a non-current asset. A current asset being sold as an individual asset, not as a part of a disposal group, is never classified as held for sale. Where a group of is being disposed of in a single transaction, its classification and presentation requirements apply to the disposal group as a whole, including current assets and liabilities forming part of the group. Available for immediate sale. The asset or disposal group must be available for immediate sale in its present condition. The terms that are usual and customary for sale of similar assets or disposal group doesn't disqualify to being classified as held for sale. However, they will not be considered as available for immediate sale if they continue to be vital for the entity's ongoing operations or being refurbished to enhance their value. Thus, an asset or disposal group cannot be classified as a non current asset or disposal group held for sale if the entity intends to sell it in a distant future. Example 1 to 5 available for immediate sale. 1. A property being used as a headquarters by the entity needs to be vacated before it can be sold. The time required to vacate the building is usual and customary for sale of such assets. Hence, the property can be considered as available for immediate sale. However, if the property can be vacated only after a replacement is available, then this may indicate that the property is not available for immediate sale but only after the replacement becomes available. Example 2. An entity can't classify a manufacturing facility as held for sale if prior to selling the facility, it needs to clear a backlog of uncompleted orders. However, if entity intends to sell the manufacturing facility along with the uncompleted orders for immediate sale. Example 3. An entity plans to renovate its property to increase its value prior to selling it to a third party. The entity is already searching for a buyer at current market values, but due to the plans to renovate the property prior to sale, the property may not be meeting the condition of available for immediate sale. Example 4. A company has put a property on the market and expects that all the conditions of classification as held for sale are met. Any buyer will undertake searches and valuations before making an offer and exchanging contracts. Such conditions are normal for properties, and any delays that might arise from such legal processes do not preclude the property from being classified as held for sale. When minor pre-selling activities are outstanding and those activities are usually performed immediately before an asset is transferred, the asset could nevertheless be appropriately treated as available for immediate sale. However, where an asset is still in the course of construction and significant activities will need to be performed before it can be transferred, it is unlikely that it could be regarded as available for immediate sale. Sale must be highly probable. The standard defines highly probable as significantly more likely than probable, where probable means more likely than not. In days 10, following five conditions to be satisfied, the appropriate level of management must be committed to the asset or disposal group. 2. An active program to trace a buyer and complete the selling plan must have been initiated. 3. The asset or disposal group must be actively marketed for price that is reasonable in relation to its current fair value. 4. The same transaction is expected to be completed within 1 year from the date of classification. 5. Significant changes to or withdrawal from the plan to sell the asset are unlikely. The likelihood of shareholders' approval should also be considered as part of assessment if it is required in the jurisdiction. Examples 6 and 7 requiring shareholders' approval. At the end of the reporting period, At the end of the reporting period, ABC Company's board of directors has approved a plan to sell a non-current asset. The eventual disposal requires approval by a majority of company's shareholders through a formal vote which will take place after the reporting period. At the end of the reporting period, a majority of the company's shareholders have provided the company with signed irrevocable agreements stating that they will vote in favor of the disposal. The highly probable test is met because the shareholders have irrevocably committed to approving the transaction, and therefore the vote by the shareholders is merely a formality. Example 7. Company XYZ holds an 85% interest in a subsidiary. Company ABC at the year end, the board of directors of Company ABC has approved a plan to sell a non current asset to Company XYZ. The eventual disposal requires approval by a majority of company ABC's shareholders through a formal vote which will take place after the reporting period. For a transaction with a major shareholder, in this case the parent, the minority shareholders are given protection in law if the value of the transaction exceeds a specified threshold. Let me read this example once again. Company XYZ holds an 85% interest in a subsidiary, Company ABC. At the end, the board of directors of company ABC has approved a plan to sell a non-current asset to company XYZ. The eventual disposal requires approval by a majority of company ABC shareholders through a formal vote which will take place after the reporting period. For a transaction with a major shareholder, in this case the parent, the minority shareholders are given protection in law if the value of the transaction exceeds a specified threshold. The law prevents company XYZ from participating in the formal vote on such a transaction. Company ABC has not received any undertakings to vote in a particular manner from any of the shareholders. It is possible that the proposed transaction may be controversial and the outcome of the shareholder vote is uncertain. From company ABC's perspective, the highly probable test is not met at the end of the reporting period because the outcome of the formal vote by the remaining shareholders is too uncertain. Other key points: loss of control in subsidiary. An entity which has committed to a sale plan which involves loss of control of subsidiary shall classify all the assets and liabilities of the subsidiary as held for sale in its consolidated financial statements when the criteria set out above is met, regardless of whether the entity will retain a non controlling interest in its former subsidiary after the sale. Exception to the period of 1 year. An entity can classify an asset or disposal group as held for sale even if the time frame of 1 year to conclude the sale transaction has lapsed. For this, the delay must have been caused by the events or circumstances which are beyond the control of the entity, and there must be sufficient evidence that the entity is still committed to its selling plan. Examples 8 to 10. An entity is committed to its selling plan of a manufacturing facility in its present condition and so classifies it as held for sale. After a firm purchase commitment, the buyer's inspection identifies environmental damages not previously known to exist. The entity is required by the buyer to make good the damage, which will extend the period required to complete the sale beyond 1 year. However, the entity has initiated actions to make good the damage and satisfactory rectification is highly probable. In this situation, exception to 1 year requirement will be met. An entity in the mining industry, example 9, an entity in the mining industry is committed to a plan to sell disposal group that represents a significant portion of its regulated operations. The sale requires regulatory approval, which could extend the period required to complete the sale beyond 1 year. Actions necessary to obtain approval cannot be initiated until after the buyer is known and a firm purchase commitment is obtained. However, a firm purchase commitment is highly probable within 1 year. In this situation, the exception to the 1 year requirement will be met. Example 10. A company is committed to a plan to sell a non current asset and classifies the asset as held for sale. During the initial 1 year period, the market conditions deteriorated, and as a result, the asset could not be sold by the end of that period. During that period, the company actively solicited but did not receive any reasonable offers to purchase the asset. and in response, the company reduced its asking price. The asset continues to be actively marketed at a price that is reasonable given the change in market conditions. In this situation, the exception to the 1 year requirement will be met. At the end of the initial 1 year period, the asset would continue to be classified as held for sale. Next point. Sale includes exchange. Sale transaction includes exchange of non-current assets for other non-current assets where the exchange has commercial substance in accordance with Ind AS 16 PPE. Next point. Asset acquired exclusively with a view to subsequent disposal. When an entity acquires a non current asset or disposal group exclusively with a view to its subsequent disposal, the non current or disposal group is classified as held for sale at the acquisition date if both of the following conditions are met. What are the conditions? The 1 year requirement is met subject to exceptions mentioned in above, and it is highly probable that any other criteria that is not met at the acquisition date will be met within a short period following the acquisition, usually within 3 months. Example 11. An entity has acquired a building exclusively with a view of its subsequent disposal. The management is highly confident that the property can be sold in 1 year. The property requires refurbishing it to enhance its value, which is highly probable to be completed in less than a period of 3 months. The building will be classified as held for sale on the date of acquisition itself, even though it is not immediately available for sale. Criteria met after reporting date. If the criteria of held for sale are met after the reporting day period, an entity should not classify a non-current asset or disposal group as held for sale in those financial statements when issued. However, when those criteria are met after the reporting period but before the approval of the financial statements for issue, the entity shall disclose the information specified in 7.6.3 disclosures. Classification as held for distribution. A non current asset or disposal group is classified as held for distribution to owners when the entity is committed to distribute the asset or disposal group to the owners. The asset must be available for immediate distribution in its present condition, and the distribution must be highly probable. For the distribution to be highly probable, actions to complete the distribution must have been initiated and should be expected to be completed within 1 year from the date of classification. Actions required to complete the distribution should indicate that it is unlikely that significant changes to the distribution will be made or that the distribution will be withdrawn. The probability of shareholders' approval, if required in this jurisdiction, should be considered as part of the assessment of whether the distribution is highly probable. For an entity to classify a non current asset or disposal group as held for distribution to its owners, it is necessary to follow the same criteria as required for classification as held for sale. Non current assets to be abandoned. Non current assets that need to be abandoned will not qualify to classify as held for sale. Just a second. Non-current assets to be abandoned. Non-current assets or disposal groups that need to be abandoned will not qualify to classify as held for sale because their carrying amount will be principally recovered through continuing use in the entity's operation rather than through sale. However, if this disposal group to be abandoned meets the criteria as prescribed in Ind 105 to be classified as a discontinued operation, then the disclosure regarding discontinued operation must be presented. Example 12. In February 2002, PQR Limited decided to abandon all of its coal mines, which constitute a major line of business. All work stops at the coal mines because the year ended 31st March X2. In the financial statements for the year ended 31st March X1, results and cash flows of the coal mines are treated as continuing operations. In the financial statements for the year ended 31st March X2, the result and cash flows of the coal mines are treated as discontinued operations and PQR Limited is required to make disclosure as per Ind AS 105. Non-current assets or disposal groups to be abandoned include non-current assets or disposal groups that are to be used to the end of their economic life and non-current assets or disposal groups that are to be closed rather than sold. Assets that are temporarily taken out of use are not to be accounted for as abandoned. Example 13. Entity ceases to use a manufacturing plant because demand has declined. However, the plant is maintained in a workable condition and it is expected to be brought back into use in future when demand picks up. It is neither to be treated as abandoned asset nor as held for sale because its carrying amount will be principally recovered through continuous use. Therefore, the entity will not stop charging depreciation or treat it as held for sale. This is because its carrying amount will be recovered principally through continuing use to the end of its economic life. So here are the key requirements of non-current assets held for sale or held for distribution to owners, available for immediate sale or distribution in its present condition, and sale or distribution must be highly probable. Management should be committed to a plan to sell and distribute the asset. An active program to locate a buyer and complete the plan or distribution has been initiated. Asset is actively marketed for sale at a price that is reasonable in relation to its current fair value. Sale distribution should be expected to qualify for recognition as a completed sale or distribution within 1 year from the date of classification. It is unlikely that the significant changes to the plan will be made for completion of plan, sale, distribution, or plan/slash distribution should not be withdrawn. So an entity shall classify a non-current asset or disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. Sale transaction include exchanges of non-current assets for other non-current assets when the exchange has commercial substance. If the entity if the entity remains committed to its committed to its plan to sell the asset or disposal group, events or circumstances beyond the entity's control may extend the period to complete the sale beyond 1 year. Particular acquisition of non-current asset or disposal group with intention to sell subsequent sale within a year. Classify the non-current asset as held for sale subject to the conditions specified in the above chart. Non-current assets that are to be abandoned, it shall be not be classified as held for sale since its carrying amount will be recovered principally through continuing use and not from sale. Measurement of non-current assets or disposal groups classified as held for sale. Measurement at the lower of carrying amount and fair value less cost to sell. An entity should measure a non-current asset classified as held for sale at the lower of its carrying amount and fair value less costs to sell. An entity shall measure a non-current asset or disposal group classified as held for distribution to owners at the lower of its carrying amount and fair value less cost to distribute. If a newly acquired asset or disposal group meets the criteria to be classified as held for sale, it will be measured on initial recognition at the lower of its carrying amount had it not been so classified, for example, and fair value less cost to sell. Hence, if the asset or disposal group is acquired as part of a business combination, it will be measured at fair value less cost to sell. Immediately before the initial classification of the asset as held for sale, the carrying amounts of the asset is measured in accordance with the applicable Ind AS. On subsequent measurement, remeasurement of a disposal group, the carrying amount of any assets and liabilities that are not within the scope of measurement requirements of this Ind AS but are included in a disposal group classified as held for sale should be remeasured in accordance with applicable Ind AS before the fair value less cost to sell of the disposal group is remeasured. When the sale is expected to occur beyond 1 year, the entity should measure the cost to sell at their present value. Any increase in the present value of the cost to sell that arises from the passage of time shall be presented in profit and loss as financing cost. Recognition of impairment losses and reversals. An entity should recognize an impairment loss for any initial or subsequent write down of the asset to fair value less cost to sell, to the extent that it has not been recognized in accordance with subsequent remeasurement of scoped out assets and liabilities as mentioned above. Oh, why is this dog barking so much? Let me fix the dog. Just a second. Okay, recognition of impairment losses and reversals. An entity should recognize an impairment loss for any initial or subsequent write downs of the asset or disposal group to fair value less cost to sell to the extent that it has not been recognized in accordance with subsequent remeasurement of scoped out assets and liabilities as mentioned above. An entity should recognize gain for any subsequent increase in fair value less cost to sell of an asset, but not in excess of the cumulative impairment loss that has been recognized either in accordance with this Ind AS or previously in accordance with Ind AS 36. Depreciation and amortization shall be immediately stopped from the moment the asset has been classified as held for sale. Interest and other expenses attributable to the liabilities of a disposal group classified as held for sale shall continue to be recognized. An entity should recognize a gain for any subsequent increase in fair value less cost to sale of a disposal group, to the extent that it has been recognized in the remeasurement of scoped out non-current assets, current assets and liabilities, but not in excess of the cumulative impairment loss that has been recognized either in accordance with this Ind AS or previously in accordance with Ind AS 36 on the non-current assets that are within the scope of the measurement requirements of this Ind AS. The impairment loss or any subsequent gain recognized for a disposal group should reduce or increase the carrying amount of the non-current assets in the group that are within the scope of the measurement requirements of this Ind AS. The impairment loss shall be allocated to disposal groups in the following order. First, to reduce the carrying amount of any goodwill allocated to the disposal group, and then to the other assets of the disposal group pro rata on the basis of carrying amount of each asset in the group. A gain or loss not previously recognized through remeasurement by the date of the sale of a non-current asset should be recognized at the date of derecognition. Requirements relating to derecognition are set out in paragraph 67 to 72 of Ind AS PPE and paragraphs 112 to 107 of Ind AS 38 intangible assets. So we have illustration 1, measurement prior to classification as held for sale. Entity ABC owns an item of PPE and it was stated at the following amounts in its last financial statements. Cost 12 lakhs, depreciation to 6 lakh, net book value 6. The asset is depreciated at an annual rate of 10%, that is 1.2 lakhs per annum. Entity ABC closes its book at 31st March each year. During July 2000X1, entity ABC decides to sell the asset, and on 1st August, it meets the condition to be classified as held for sale. Analyze what will be the treatment of the property in the books of for the year 2000X1 to 2000X2. At 31st July, entity ABC should ensure that the asset is measured in accordance with Ind AS 16. It should be depreciated by further 40,000, 1,20,000 into 4 by 12, and should be carried at 5,60,000 before it is measured in accordance with Ind AS 105. So basically, charge 4 months of depreciation, that is the period up till August, and then you classify it as per Ind AS 105. From the date the asset is classified as held for sale, no further depreciation will be charged. Example 14. Classification as held for sale. A Limited acquired a property for 2 lakhs. After few years, the cumulative depreciation on the property of 80,000 has been recognized, and subsequently the property is classified as held for sale under Ind AS 105. At the time of classification as held for sale, it will be measured at lower of its carrying amount, which is 1.2 lakhs, 2 lakh minus 80,000, and fair value less cost to sell as estimated at 1 lakhs. Accordingly, there is a write down on initial classification of property as held for sale, and accordingly, the property is carried at 1 lakh rupees. A loss of 20,000 is recognized in profit or loss. On the next reporting day, if the property's fair value less cost to sell is estimated at 85,000, accordingly a loss of 15,000 is recognized at in profit or loss, and the property is carried at 85,000. Subsequently, the property is sold for 90,000, a gain of 5,000 will be recognized. Disposal group classified as held for sale. The entities, there's a carrying amounts are given at the reporting date before classification as held for sale. Carrying amount as remeasured immediately before classification as held for sale. So we'll consider the immediately before classification as held for sale figures. So there's goodwill at 1500, PPE at 4000, building at 5700, inventory 2200, investment in equity 1500. So the total disposal group value carrying amount is 149. So the entity should recognize the loss of 1100, 16,000 minus 14,900 in accordance with applicable Ind AS immediately before classifying it as held for sale. This difference of 1100 reflects routine accounting entries such as revaluation. The amount shall not be considered as impairment loss. Okay. The entity estimated that fair value less cost to sell of the disposal group amounts to 13,000. Since the entity has classified a disposal group as held for sale, it should be measured at load of its carrying value, a fair value less cost to sell, which comes to 13,000. Entity should recognize impairment loss of 1900 when the disposal group is finally classified as held for sale. The inventory and investment is measured as per Ind AS 2 and 109 at not more than fair value at the date of measurement remeasurement immediately before classified as held for sale. The impairment loss of 1900 is allocated to remaining assets in the proportion of their carrying value other than the inventory and investment in equity instruments. The allocation of impairment loss can be illustrated as follows. So first, we'll dedicate the as much loss as we can to the value of goodwill. So we allocated 1500 of loss to the goodwill, and for the rest 4000 and 5700 we allocated in the ratio of 40 is to 57. So 40 plus 57 is 97, and 400 into 40 divided by 97 comes out to 164.9, which is 165. So this is the way loss booked impairment losses are allocated to scoped in non-current assets within the disposal group. Firstly, the impairment loss reduces the amount of goodwill in the disposal group. Then the remaining impairment loss is recognized to other assets pro rata based on the carrying amount of those assets. Suppose at the end of the reporting period, the fair value less cost to sell is increased and estimated at 15,500. The maximum impairment loss reversal allowed will be 1900, being impairment loss recognized earlier. The reversal or impairment loss on goodwill is not allowed under Ind AS 36 impairment of assets. Example 16, reversal of impairment losses. A freehold property was originally acquired for 40 lakhs. Some years later, after cumulative depreciation of 11 lakhs has been recognized, an impairment loss of 3.5 lakhs is recognized, taking the carrying amount to 25 lakh 50,000, which represents the estimated value in use of the property. Shortly thereafter, as a consequence of a proposed move to new premises, the freehold property is classified as held for sale. At the time of classification as held for sale, carrying amount is 25 lakh 50,000. Fair value less cost to sell is assessed at 25 lakhs. Accordingly, the initial write down on classification as held for sale is 50,000 and the property is carried at 25 lakhs. Following the classification as held for sale, no further depreciation is recognized. At the next reporting date, the property market has improved and fair value less cost to sell is reassessed as 26.5 lakhs. The gain of 1.5 lakh is less than the cumulative impairment losses recognized to date. So 3.5 plus 54. Accordingly, it is credited in profit and loss and the property is carried at 26 lakh 50,000. 6 months after that, the property market has continued to improve and the fair value less cost of sale is now assessed at 30 lakhs. The this further year of 3.5 is, however, in the excess of cumulative recognized losses up till date, that is 3.5 plus 50 minus 1.5 is 2.5. Accordingly, a restricted gain of 2.5 is credited to the profit in profit and loss, and the property is carried at 29 lakhs. Subsequently, the property is sold for 30 lakhs, at which time a gain of 1 lakh is recognized. Changes to a plan of sale. If an entity has classified an asset or disposal group as held for sale, but the held for sale criteria is no longer met, in that case, the entity should cease to classify the asset or disposal group as held for sale. The entity shall measure a non current asset that ceases to be classified as held for sale at the lower of, just a second. Changes to a plan of sale. If an entity has classified an asset or disposal group as held for sale, but the held for sale criteria is no longer met, the entity should cease to classify the asset or disposal group as held for sale. The entity shall measure a non current asset that ceases to be classified as held for sale or ceases to be included in a disposal group at the lower of its carrying amount before the asset or disposal group was classified as held for sale, adjusted for any depreciation, amortization, or revaluations that would have been recognized at the asset not being classified as held for sale, and its recoverable amount at the date of the subsequent decision not to sell. The entity shall include any required adjustment to the carrying amount of a non-current asset that ceases to be classified as held for sale in profit and loss from continuing operations in the period in which the held for sale criteria is no longer met. Financial statements for the period since classification as held for sale or distribution to owners shall be amended accordingly if the disposal group or non-current asset that ceases to be classified as held for sale, distribution to owner is a subsidiary, joint operation, joint venture, associate, or a portion of an interest in a joint venture or an associate. If an entity removes an individual asset or liability from a disposal group classified as held for sale, the remaining assets and liabilities of the disposal group will continue to be measured as a group only if the group meets the criteria for classification as held for sale. Otherwise, the remaining non-current assets of the group that individually meet the criteria to be classified as held for sale shall be measured individually at the lower of their carrying amounts and fair value less cost to sell at that date. And any non-current assets that do not meet the criteria shall cease to be classified as held for sale. Remeasuring non-current assets that are no longer held for sale. Company ABC has several operations including the manufacture and sale of leisure equipment. Company ABC financial year ends on 31st March. In April, Company ABC adopts a plan to sell all of the assets and liabilities of the leisure equipment operations. Having met the requirements of Ind AS 105 at the end of the first quarter, Company ABC appropriately classifies those assets and liabilities as a disposal group held for sale. In September, Company ABC decides not to sell certain existing trademarks and license arrangements associated with the leisure equipment operations. Subsequent to the sale of the other asset and liabilities, Company ABC will continue to generate revenue from its trademarks and licenses. Company ABC should reclassify the trademarks and license agreements out of the assets held for sale and remeasure them at the lower of their carrying amounts before being classified as held for sale, less any amortization expenses that would have been recognized if they had not been classified as held for sale. The recoverable amount at the date of the subsequent decision not to sell. If this requirement triggers an adjustment to the carrying amounts of the trademarks and licenses, assuming that the assets were not revalued in accordance with Ind AS 38 before classification as held for sale, the adjustment should be included in profit or loss from continuing operations in the period in which the held for sale criteria are no longer met. The adjustment should be included in the same caption in the statement of profit and loss to present other gains or losses, if any, on held for sale items not meeting the definition of discontinued operations. If the remaining assets and liabilities of the leisure equipment continue to meet the conditions to be accounted as for as held for sale, ABC should continue to classify those remaining assets and liabilities as held for sale. Illustration 2. S Limited purchased a property for 6 lakh on 1st April X1. Useful life of the property is 15 years. 31st March X3, S Limited classifies the property as held for sale. Impairment testing provides the estimated recoverable amount of 4.7 lakhs. Fair value less cost of sale was 4.6. On 31st March 2004, management changed this plan. Property no longer met the criteria for held for sale. Recoverable amount on 31st March X4 is 5 lakhs. Recommend the accounting treatment of events at the year ending X3 and X4 and value of property at the end of X3 and X4. So the value of property immediately before classification 60,000 will do the accumulated appreciation and the impairment loss, so carrying amount is 4.7 lakh. On initial classification as held for sale on 30th, the value will be lower of 4.7 or 4.6. The reason of it, say 4.6. Depreciation of 40,000 and impairment loss of 60 is charged in profit and loss for the year ended 31st March X3. Okay, so it's that depreciation is 10, sorry, 15 divided 6 lakh divided by 15 is 40,000. Okay, it's fine. Good. Now, on initial classification as held for sale, okay. B. On 31st March X4, held for property sale is reclassified as criteria not for sale. The value will be lowered off. Carrying amount immediately before classification, 4.7, less depreciation based on 13 years balance life, 36,154. Carrying amount had the asset is not classified as held for sale, 433,846. Recoverable amount 5 lakhs. Property will be valued at 433,846 on 31st March X4. Adjustment to the carrying amount 26,154 is charged to the profit or loss. Presentation and disclosure of a non-current asset classified as held for sale. Non-current assets and disposal group classified as held for sale. Entity shall present and disclose information about NCA or disposal group classified as held for sale in such a manner that enable the users of financial statements to evaluate financial effects of non-current asset or disposal group classified as held for sale. Presentation. An entity is required to present a non-current asset classified as held for sale and assets of a disposal group classified as held for sale separately from the other assets in the balance sheet. The liabilities of a disposal group classified as held for sale should be presented separately from other liabilities in the balance sheet. Those assets and liabilities should not be offset and presented as single amount. The major classes of assets and liability classified as held for sale should be separately disclosed either in the balance sheet or in the notes, except when the disposal group is a newly acquired subsidiary that meets the criteria to be classified as held for sale on acquisition. An entity should present separately any cumulative income or expense recognized in other comprehensive income relating to a non-current asset or disposal group classified as held for sale. If the disposal group is a newly acquired subsidiary that meets the criteria to be classified as held for sale on acquisition, disclosure of the major classes of assets and liabilities is not required. Comparative amounts for non-current assets or for assets and liabilities of disposal group as held in for prior periods are not reclassified or represented to reflect the classification in the balance sheet for the latest period presented. For example, if the asset qualifies as held for sale during 2000 X2, it should be classified as such in balance sheet at the end of 2000 X2, but not in 2000 X1 comparative balance sheet. Any gain or loss on the remeasurement of non-current assets classified as held for sale does not meet the definition of a discontinued operation shall be included in the profit or loss from continuing operations. Example 18, presentation of disposal group, PPE, liabilities, net carrying amount. An amount of 400 relating to these assets has been recognized in other comprehensive income and accumulated in equity. Disclosures. An entity should disclose the following information in the notes of the financial statements in the period in which a non-current asset has been either classified as held for sale or sold. Description of the non-current asset or disposal group, description of facts and circumstances of the sale leading to the expected disposal and the expected manner and timing of the disposal, gain or loss recognized and if not presented separately on this face of statement of profit and loss, the caption in the statement of profit and loss that includes that gain or loss, If applicable, the reportable segment in which the non-current asset or disposal group is presented in accordance with Ind AS 108 operating segments. If there is a change of plan to set a description of facts and circumstances relating to the decision and the effect of the decision on the results of the operations for the period and any prior periods presented. Discontinued operations. Definition. Ind AS 105 defines discontinued operations as a component of the entity that either has been disposed of or is classified as held for sale and represents a separate major line of business or geographical area of operations is part of a single coordinated plan to dispose of a separate major line of business or geographical area of operations is a subsidiary acquired exclusively with a view to resale. Discontinued operations example 19 to 22. Company XYZ has five different operating segments, one of which solely produces consumer goods. All of the consumer goods production facilities are situated in Central Europe. XYZ also has other operations in Central Europe for other operating segments. In April 2001, XYZ disposed of its consumer goods segment, which meets the definition of a component of a business and represents a separate major line of business and would therefore be continued as a discontinued operation. Example 20. A group has announced that it is closing an engineering contracting segment. Although no new contracts are being undertaken, all existing contracts will be completed and the business will be run down accordingly. In this situation, the operation will have ceased to be used when the contracting activity has been completed, that is, at the end of the last contract. In the period during which existing contracts are completed, the group is continuing to carry out a revenue earning activity, albeit the activity is being wound down, and so it does not qualify as a discontinued operation. Example 21. A company carried out a merchandise wholesaling business that is operated from several leasehold premises throughout the country. The business has been closed, all stocks have been disposed of, and employees have been made redundant before the end of 3 months into the next financial year. At that time, some debtors remain to be collected, and costs will continue to be incurred in respect of the vacated premises until the leases are disposed of. In this case, the former activity of merchandise wholesaling has ceased. The outstanding future transactions do not constitute a continuation in the activity, and consequently, the operation has been discontinued. Final example 22. XYZ company has one business segment and it operates in the UK, the US, and Australia. Each of these operations represent a component of XYZ and a major geographical area of operations. Management has decided to sell the US operation, which met the criteria to be classified as held for sale during the year. The US operation should be disclosed in XYZ financial statements as a discontinued operation, despite the fact that there has been no change to the number of business segments. A component of an entity comprises operations and cash flows that can be clearly distinguished operationally and for financially reporting purpose from the rest of the entity. In other words, a component of an entity will be cash generating unit or a group of cash generating units while being held for use. Illustration 3. Okay, illustration 3. Before doing that, we'll complete the study material. Separate presentation of discontinued operations. An entity should present and disclose information that enables users of financial statements to evaluate the financial effects of discontinued operations and disposals of non-current assets. This allows the user to distinguish between the operations which will continue in the future and those which will not, and make it more predictable the ability of entity to generate future cash flows. When the amounts relating to discontinued operations are presented separately, the comparative figures for prior periods are also represented, so that disclosures relate to all operations that have been discontinued by the end of the reporting period for the latest period presented. Presentation and the statement of profit and loss. An entity shall disclose a single amount in the statement of PL comprising total of post-tax profit or loss of discontinued operations and post-tax gain or loss recognized on the measurement of fair value less cost to sell or on the disposal of asset or disposal group constituting the discontinued operation. In addition, this single amount must be analyzed into the revenue, expense, pre-tax profit or loss of discontinued operations, the related income tax expense as required under Ind AS 12, the gain or loss recognized on the measurement to fair value less cost to sell or on the disposal of the assets or disposal group constituting the discontinued operation, related income tax expense as required. The analysis may be presented in the notes or in the statement of PL. If it is presented in the statement of PL, it should be presented in a section identified as related to discontinued operations separately from continuing operations. The analysis is not required for disposal groups that are newly acquired subsidiaries and meet the criteria to be classified as held for sale on acquisition. Entities are required to disclose the amount of income from continuing operations and from discontinued operations attributable to owners of the parent. These disclosures may be presented either in notes or in the statement of P&L. Disclosure in the statement of cash flows disclose that net cash flows attributable to the operating, investing, and financing activities of discontinued operations. These disclosures may be presented either in the notes or in the financial statements. These disclosures are not required for disposal groups that are newly acquired subsidiaries that meet the criteria to be classified as held for sale on acquisition. Disclosure on earnings per share. EPS amounts should be shown separately when an entity reports discontinued operations. Requires an entity that reports discontinued operations to present basic and diluted per share for discontinued operations, either in the statement of PLL or in the notes of financial statement. This disclosure is required in addition to the presentation of basic and diluted per share amounts for profit and loss from continuing operations and profit and loss for the year, both of which should be shown in the profit and loss with equal prominence. Adjustment to prior period disposals. Adjustments in the current period to amounts previously presented in discontinued operations that are directly related to the disposal of a discontinued operation in a prior period should be classified separately in discontinued operations. The nature and amount of such adjustments are disclosed. Example of circumstances in which these adjustments may arise include the following: the resolution of uncertainties that arise from the terms of disposal transactions, such as resolution of purchase price adjustments and indemnification issues with the purchaser, the resolution of uncertainties that arise from and are directly related to the operations of the component before its disposal, such as environmental or product warranty obligations retained by the seller, the settlement of employee benefit plan obligations, provided that the settlement is directly related to the disposal transaction. Change to a plan of sale. If an entity ceases to classify a component of an entity as held for sale, the results of operations of the component previously presented in discontinued operations should be reclassified and included in income from continuing operations for all periods presented. The amounts for prior periods should be described as having been represented. Loss of control in subsidiary. An entity that is committed to a sale plan involving loss of control of a subsidiary should disclose the information as above when the subsidiary is a disposal group that meets the definition of discontinued operations. Okay, fine, we have done. Also, the significant difference between 105 and 24. Okay, we'll leave this now. We'll go to this illustration. Identify whether each of the following scenarios give rise to a discontinued operation and or classification of asset as held for sale. MNO disposes of a component of the entity by selling the underlying assets. The sale transaction is incomplete at the reporting date. Yes, discontinued operation. Yes, and asset held for sale, I think, will also be yes. Yeah, correct. PQR has seized activities that meet the definition of a discontinued operation without selling any assets. Seized activities that meet the definition of discontinued operation. Okay, they are saying that the definition of discontinued operation is met. Then this will be yes, but without selling any active assets. So there is no intention to sell. So we'll say held for sale no, discontinued operation yes. Okay, correct. STU ceases activities that has already completed the sale of the underlying assets at the reporting date. So in this case, uh, there is no information that this is a separate, what to say, component of the business. So it will be just held for sale. Incorrect. STU ceases activities and has completed the sale of the underlying assets. So it will be a discontinued operation, but assets are held for sale will be no. Okay, so we are wrong in this. I have doubts with this. I'll ask later. VWX will sell or has sold assets that are within the scope of Ind AS 105, but does not discontinue any of its operation. Operations are not discontinued, so discontinued operations will be no. Will sell or has sold that are within the scope of 105. So yes, no and yes. Yeah, correct. Okay. Sun Limited is a retailer of takeaway food like burgers. Okay, we have done this. Okay. So that will be all.